see what is on the agenda for today. First of all, we're going to go through how the economy did in 2022, and hopefully it'll give us a little bit of a peek into 2023. We're also going to review the same store sales numbers for a few of the big chains, both in the quick service and the full service arenas. We'll also take a look at a couple of chains in the fast casual market as well. I got one slide only on the big three distributors. Just last month, I did a full webinar on how the big three did during 2022. So if you're much more interested in what happened with the big three distributors, Cisco, US, and PFG, go into our resources tab at ifmaworld.com and check out that webinar as well. I got one slide on what to expect in 2023. And this is, of course, speculative, as is anything that is looking forward. But I think a lot of it is really based on what we're seeing right now. My favorite part of the whole webinar, though, is the last part where we talk about a little bit of a recap of what IFMA accomplished in 2022. I'll give you some cool picks from the 3 in-person conferences, or 3 in-person events, I would say, that we had in 2022. There's some fun picks in there, so I'll share those with you. And then, like I said, I'm going to take questions and answers from anybody who is daring enough to throw a question in the question box. Hey, key economic indicators. Nothing says fun like a little economic data to start off our webinar here today. And for me, number one biggest story in 2022 was inflation. I know that labor and supply chain were also big stories, and there was a midterm election and all that stuff happened. But for me, if there's something that really hit home on food service, on food away from home, on the impact on food in general, it is the consumer price index. And the reason I'm going back all the way to 2002 for you, is giving you a 20-year view, is just so you can see how out of proportion 2021 and 2022 are in terms of the numbers here, especially when you're looking at the food numbers. The food in-home number, when you're up in the, in the teens in terms of inflation growth on food in-home, as you can see where it kind of peaks out there, that's a fundamental big number there, and that's one that a lot of people are feeling the pinch. And maybe in food service we can step back and say, but look at the food away from home number. It's not growing at the same rate as the food in-home number, which means that people should be going out to eat more. Remember that the majority of occasions still are in-home, that we are still feeding ourselves in-home. And if the price of our food that we're eating in-home is going up at this exponential rate, that just leaves less disposable income in our wallets to go spend away from home. And then the fact that the food away from home number is not growing at the same rate as the food in-home number means that the margins for food service operators are being managed downward because they're unable to pass along some of the costs of goods that they're absorbing and bringing those in. And so in essence, what they're doing is they're just unable to give you guys, the consumers, the price increases that the grocery stores are able to pass along. Now, you will notice if you look at right at the end of the tail there, the numbers are going down for both all items and also for food in home. So I would say that it looks to be there's some relief on the way. We'll see as we head into 2023 where that goes. Another big story during 2022 was the really high gas prices that we saw, and we continue to see above average gas prices, peaking in June of this year when we were over $5 a gallon on a national basis. Obviously, in some markets, this was lower. In other parts of the country, it was actually higher. So lot of fretting and wringing of hands around the whole idea of, well, we've got, high gas prices, so people are going to be more reluctant to leave their homes and go out to eat. And maybe to a degree, and this is just me, I'm one of the people who's like, Americans will drive no matter what. Like, yeah, maybe it costs us some more, but if we want to go somewhere and it requires us to get in a car to go somewhere, we're going to actually get in the car and go somewhere. Maybe we cut down a little bit on some road trips that we would have taken, but in terms of our daily lives, numbers like these are not going to have a material impact on how we go outside and leave our homes, compared to, of course, something like, I don't know, a global pandemic. That'll definitely keep us in our homes, but high gas prices, sorry, we're still going to go somewhere. So, and I expect, just like the inflation number I showed in the previous slide, we expect gas prices to moderate again this winter. They'll spike again in the summer, and that's just the cyclical nature of things. The economy is showing signs of weakness, as you can see by the gross domestic product for 2022, 2 consecutive quarters of negative gross domestic product growth, which of course is supposed to signal a recession. And if it was a recession, it was a very short-lived recession. I would not be surprised if in 2023 we again see consecutive quarters of negative gross domestic product. We might even see 2, 3, 4 consecutive quarters. It could be a rough year in terms of overall economic growth, mainly due to the fact that the Fed is trying to actually slow down growth. And the way they're doing that is they're raising interest rates, and increased interest rates reduces the amount of borrowing that America does. And when we have less borrowing, we have less money, and the economy slows down. So the Fed is actually going to accomplish what they want to accomplish, which is to curb inflation. And in doing so, they are going to decrease the ability of the economy, U.S. economy, to grow. And there's all the reason to expect that in 2023, the economy is going to have a tough year in terms of growth. Now, throughout all of this, the unemployment rate for 2022 pretty much stayed exactly the same. And there was a lot of discussion around the lack of labor that is available in food service, especially for some of those frontline jobs like truck driving, like working in warehouses, being a picker in a warehouse, being a cook, a dishwasher, a busser, a server, whatever it might be. All those jobs were in high demand in 2022. And I don't know, it's hard to say what it's going to be like. I think the labor crunch that we experienced at the end of 21 and through most of 2022, I think it's going to ease in 23. I don't know, but that's the way I feel. I feel the unemployment rate's probably going to go up. It's not going to go down any further from this 3.6, 3.7 number that we had pretty much the entire year. So I anticipate that we're going to see unemployment go up, and that in turn will have more people looking to fill those that we have had a hard time filling in 2022. Naturally, unemployment rate goes up, less people are employed, less money in the economy, less people going out to eat. It's always a give and take, isn't it? This is the number that really worries me the most as I look forward to 23. And the reason I included all of 21 to the left of the red line is just to show you that consumers overall, in terms of their confidence level, we're actually a lot more bummed out in 22 than we were the year after the pandemic, 2021. So if you can literally say, hey, 2020 was the year of the pandemic, even though I think a lot of us would say that 21 was also a pretty pandemic-y type year. But I mean, these numbers in terms of confidence levels, I mean, look at that June number, a solid 50. That's really low. I went back as far, a really long ways back and looked at this number, and it's been a long time since we've had numbers this low in terms of our consumer confidence. And it's not reflected, obviously, in spending patterns. We've continued to spend, we've continued to do our part as consumers to help the economy grow, but we're not doing it because we're necessarily excited about the prospects of how things are going. So as consumers look forward, they're not very optimistic is the best way to look at this. They're actually historically not optimistic is one way of putting it. So this is the number that worries me the most, like I said, in terms of looking forward to 23. With that kind of bummer, let's switch gears now and talk a little bit about our restaurant chain performance. In order to do that, I'm going to have just a little bit of coffee. Keep myself energized as we go through some numbers. So in terms of restaurant chain performance, what I'm going to show you is same store sales numbers. And just to be clear about what same store sales numbers are, they are a comparison in terms of sales of locations within a restaurant system that have been open for more than a year. So you've got location A, it was also open last year. So this takes out the impact of any type of restaurant openings or closures that have happened within a system. So this is meant to be a sort of organic look at how a restaurant chain overall is performing. Now there's three main factors that go into same store sales growth or decline. First of all, did more people go to the restaurant? So that's traffic. Was there a change in the mix of products that they bought when they were in the restaurant? So that if they bought more higher priced items and more and less lower priced items, that of course is going to increase sales. And then the third factor, and the factor that's probably the biggest in 2022, is just increasing prices on the menu. So what might have cost $2.59 last year now costs $2.99 this year. That is going to have a material impact on overall same store sales. So keep that in mind, right? Traffic, mix, and price increases on the menu. So here's the burger guys first. We got McDonald's, BK, Wendy's, and Jack in the Box. And we've got Q4 of 21 and then Q1, 2, and 3 of 2022. And whenever you see the numbers in parentheses, that means that was a decline versus a year ago. So for example, here, Q1 2022, McDonald's showed a negative 0.5 growth rate compared to a year ago. So biggest takeaways from where the burger guys were. First of all, McDonald's clear winner. When you look at these four, by far the best same store sales results across the board. Of course, if you do listen to what they're talking about in terms of what's driving these same store sales growth, they are attributing a fair amount of that to price increases that McDonald's has taken on their menu, but they also are giving a lot of credit to their use. They're making digital their app and pre-ordering and ordering for delivery and all that. They're basically saying we're doubling down on digital as a way to drive growth within our system. So not to say that Burger King, Wendy's, and Jack in the Box are not doing the same. It just happens that when consumers are opening up and thinking about where to go and get a burger to be delivered, it seems like McDonald's is popping to the top of the list in terms of choices that consumers are making. Wendy's was probably number 2 in terms of overall performance. Keep in mind the fact that Wendy's has been now offering breakfast across much of their system. Obviously, you add a day part. That's probably another 4 reason that you can increase your same store sales is you're open more hours. That's what Wendy's has done. Now they're starting to lap the breakfast. So In 2022, much of the growth that you're seeing in 22 is where they had breakfast both open in 21 and in 22. So much of that 6.4% growth you see here in the most recent quarter for Wendy's, that's all strong. Now you look across the board here, all 4 chains had a solid growth number in the most recent quarter. A lot of that, of course, is attributed to price increases that they've been forced to take on their menus. How about the pizza guys? Pizza Hut and Domino's, I would say that the main takeaway here is that it was a rough year for the pizza guys, both for both of these brands. As you can see, Domino's had a negative 3.6, followed by a negative 2.9 in the first half of 22. Pizza Hut was down 6% and 4% in the first half. So now, if you think about it, there were a couple, these are the brands that actually really did well during COVID. And so they're beginning to see some of the after effects of everybody else now getting back into the game. They did not have to turn themselves down and shut down or anything during COVID. They were able to stay open and actually were able to benefit from the fact that consumers were less willing to leave their homes. So they were calling up Pizza Hut and Domino's, ordering on their apps and having pizza delivered. So as those 2 chains lap against those tough comparisons from a year ago, you can see the negative numbers that they're experiencing. In terms of KFC, Popeyes, and Taco Bell, the chicken wars finally caught up to Popeyes. They were sort of the leader, and they were the ones who stuck themselves out and said, we have the best chicken sandwich, and social media followed along and said, Popeyes has the best chicken sandwich out there. Everyone copied Popeyes' version of their chicken sandwich. Everyone launched a version of their chicken sandwich, and that's what happens to Popeyes, is they have to now recover from what has been a tough competitive environment for them. For me, once again, the big takeaway here is that brand on the bottom, Taco Bell, 8%, 5%, 8%, 7%. That is solid numbers for Taco Bell. And this is a brand that continues to resonate with Americans, especially younger Americans, and they are taking advantage of the fact that it is still an economical way to feed yourself. There's a lot of new innovation, new ideas coming out of Taco Bell. It's hard to keep up with all the new menu additions they do. So this is a brand that Yum Brands is managing really well, and continues to be very favorable overall for 2022. And there's no reason to expect things to slow down for Taco Bell in 2023. Fast casual, I'm representing it with 2 brands, just 2 brands here, Starbucks and Chipotle. Both of them had gangbusters 2022. Starbucks 12%, 9%, 11% in 22, with Chipotle at 9, 10, and 7.6 in 2022 off of, you can see those Q4 numbers, incredibly strong numbers for both Starbucks and Chipotle. So yes, there were some chains in the fast casual space that struggled because they really relied heavily on that on-premise or dine-in consumer. Starbucks and Chipotle are examples of chains that are doing well despite the fact that less and less consumers want to eat inside of a restaurant, and so they're taking advantage of that. They're also, of course, heavily investing in digital as the main way to order from them. When you go into a Starbucks now and you walk in, and I'm not a Starbucks, I don't have a rewards program, so I'm just purely me looking inside of a store, and there are 20 different cups lined up in the service area with people's names on them from people who ordered off the app. And I'm sure those of you that are hardcore Starbucks users and are ordering on a regular basis, you know exactly what I'm talking about. You gotta like hope that somebody doesn't steal your cup off of the delivery system that they have there, which is entirely, it seems to be up on the honor system. I mean, it seems like you can walk up and grab any cup you want. That's just me. At some point, I think that's going to come back to bite them overall. All right, the full service chains. I got Applebee's and IHOP. I got Chili's and Olive Garden, and then everyone's favorite Cracker Barrel there at the bottom. First thing I want to point out is these Q4 numbers for 2021. So you'll see Applebee's 34.8%. That's an absurdly high same-store sales number. Oh wait, IHOP's even higher, 39.2%. Chili's 11.5%. Olive Garden 29.3%. Now Cracker Barrel only 1.9%. But if you look across this entire chart here, at no point do you see any negative numbers. The lowest number overall is Chili's in Q2, basically flat versus a year ago. So this is a sign of how the full service chains compared to the quick service chains, full service chains took more time to recover from what happened in 2020. So the reason that these numbers are so absurdly high here in Q4 of 21 is because Q4 of 2020, many of these chains were still, for the most part, shut down and just doing to-go orders or just doing pickup or just doing delivery. So they were not functioning as full restaurants anymore. So it's going to be interesting to see with the full service chains. Typically in a down economy, the chains that get hurt the most first are going to be your full service chains. They're the ones that cost the most. They're the ones that consumers are going to say, can I trade off that full service experience for a less expensive experience, either by eating in home or by using a QSR or a fast casual to fulfill that eating occasion. So I do not expect, when I'm doing this, 365 days from now, that I'm going to be showing a chart, anything like this for the full service chains. I expect there to be a lot of negative numbers for these chains in the coming year. Hopefully I'm wrong, because if these chains are doing well, that means the food service industry overall is doing well. All right, quick time check. Oh, excellent. All right, so that's the restaurant look. Quick snapshot of how the big three distributors performed. Those big three distributors are Sysco, US Foods, and PFG. Like I said, I did a webinar, full webinar dissecting their results last month. So if you missed that webinar and you want to view it, go to ifmaworld.com, go to our resources tab, and you'll find that webinar with all the slides and recording. But if you want the top line view, here it is. Just so you know, for Sysco, this is only looking at their segment that they report called US Food Service. For US Foods, it's their entire business. For PFG, this is just their food service division. This does not include their convenience segment or their Vistar segment. Now, if you look at the sales numbers and you look at the local cases or independent cases, however these companies refer to them, positive numbers across the board. In some cases, you're talking about double-digit numbers for the local cases. For the sales numbers, for all three reporting periods in 2022, there have been solid, if not extraordinary growth numbers. But what I want you mainly to focus on is the delta between the case growth and the sales growth. So for example, let's take a look at the most first here from Sysco, 5.4% growth in cases, 17.2% growth in sales. So what is causing that delta between the case growth and the sales growth? Yes, it is for the most part, and not entirely, for the most part, it's inflation, cost of goods that they are bringing in through their back door, and they're passing those costs of goods on to their customers, which is the food service operator. Now, food service operators can't be passing along 12, 13% cost of goods that they're absorbing when they're getting their invoices on the products they're buying. It's hard for them to tell a consumer, hey, by the way, our prices are up 13%. So your menu item that you're buying is going to go up 13%. In the grocery store, yes, we apparently can do that. In food service, it's just, the consumer just doesn't react the same way that we would in the grocery store. And this is true for any segment within food service. On a meal plan, you don't just raise the cost of a meal plan in a college university setting by 13% year over year. You just can't do that. A freshman is going to see that, and their parents are going to say, what in the world is going on? Same in K through 12. How about in healthcare? How about in hotels? So this was a big issue in 2022, and the distributors, for the most part, passed along their cost of goods, and it was up to the food service operator to take the margin hit because the consumer was not willing to take on the margin hit themselves within their pocketbook. So it'll be interesting to see. I do expect inflation, cost of goods in food to go down in 23. So we'll see just overall what that means for consumers, what that means for food service operators. In this case, what does that mean for distributors? But overall, Cisco, US, and PFG all had a very good 2022. Especially if you look at their case numbers, a lot of that, of course, is basically taking share away from some of the smaller distributors. So I've been hinting at this through my entire sort of monologue that I've been going on here. So what do we expect in 2023? Naturally, I caveat this with I'm being speculative here. So we meaning IFMA, we expect 23 to be a challenging year for the food service industry. Eventually, these increases in interest rates are going to have a material impact on the economy. We're already beginning to see that. If you refer back to that gross domestic product slide that I showed you early on. So if the Fed wants to slow the economy down, the Fed will slow the economy down. And eventually that is going to impact food service, and we are going to cut back on the amount of dollars that we are using on away from home dining. And we are going to start using those dollars in home in 23 more than we did in 22. So prepare yourselves that this could be a challenging year. If you want to see on the bright side of things, the big three things that we talked about in 22, inflation, labor, and supply chain challenges. There's a lot of things that are saying that's going to, those challenges are going to ease in 23. And so let's hope that we're right about that. Unfortunately, what I think is the reason they're going to ease is because there's going to be less productivity happening overall in the economy. If you go to IFMA Scope and you want to look up our forecasts for every segment within the food service industry, the away from home ecosystem, it's all available to you there. You go to ifmaworld.com, there's an icon there, it says IFMA Scope. You click on IFMA Scope, you go to the operator landscape, and you'll see our projections in real terms for 2023 for every segment. Overall, for the full food service industry, IFMA is projecting basically flat growth in 23, down 0.1% in 23. So our next forecast, our updated forecast for 23 will be in February of 23, probably near the end of that month. So, and we'll have a full webinar and let you know when that new forecast comes out. So that's the stuff we didn't want to talk about. What I do like to talk about is some of the fun things that IFMA accomplished in 2022. So for those of you that weren't able to attend all of our events, I'll give you a couple pics and snaps from that that'll hopefully give you a sense of how things went. But the biggest news for IFMA in 2022 was the arrival of this gentleman. Phil Kafarakis is now the IFMA president and CEO, so he's completing his first 12 months at the helm of IFMA, took over for Larry Obergfell. So Phil, I doubt you're listening, but hey, in case you are, Phil, we're really happy to have you on board, and congratulations on your first year at the helm of IFMA. We're looking forward to you carrying the association forward. And one of the biggest projects that Phil's been embarking on in 2022 is IFMA's long-range plan that he's been constructing along with all of us at IFMA and with the board of directors at IFMA. And so at COEX of 23, we'll really begin to see what exactly IFMA has in store for the next 3 to 4 years. So we're looking forward to seeing the fruits of all that work that Phil and the full IFMA team's been doing in 22 to bring our long-range plan to bear for the full away-from-home industry. In terms of our events, our first one was in Austin, Texas, COEX 2023. Most memorable moment, I think, was probably our outdoor event, which was held in, I think, like 40-degree weather. So freaking cold. And fortunately, there was an indoor part that we can go into. Overall, it was an amazing event. And we had representation from the board, the chair people from Big Chicken and also from Red Lobster. We had, I think, over 400 people attending, almost half of those being food service operators. We definitely brought in the on-site side of things as part of the overall conference. So for those of you that were able to attend, I hope you also agree that it was a great event. And in terms of the gold and silver plate, here are the 7 winners, actually 8, because Paco and Tina were shared this silver plate for the business and industry side of things. Lance Trineri of Golden Corral was the gold plate winner, well deserved, as he brought a buffet restaurant, which I think a lot of us thought there would never ever again be self-serve buffet restaurant. And Lance brought Golden Corral through probably its most challenging time in its entire history. He took a lot of money out of his own pocket to keep that brand and that restaurant chain alive. And for that, he is a most deserving winner of the gold plate. But all of these people are also very deserving of their silver plate winners. And I look forward to seeing a lot of you in Chicago in May of 23, when we'll be handing out a new set of silver plate winners, and we'll of course be awarding the gold plate winner to one individual in 2023. Our last event of the year, our virtual event of the year was marketing and sales that took place at the beginning of August. Because it was virtual, I don't have any pictures from it. But we did, of course, have our new forecast for 23. That was one of the highlights of the virtual marketing and sales conference. Jack Lee from Data Central talked about the three-headed monster, labor, supply, and inflation. We also had an expert with us from Planet Z, I think is what the company was called, and she talked about who is Generation Z and what can we look forward to from Generation Z overall. So materials from the virtual marketing and sales conference are still available to those of you who attended, if you want to have access to those. Our final event of the year was the IFMA President's Conference out there in Scottsdale, Arizona, at the Western Kierland Resort. We had record attendance, record number of operators showed up for the IFMA President's Conference. It was a success from A to Z across the board. And we kicked it off with 2 local members of a tribal council basically welcoming us to their land, which those of you that were actually able to attend and see that, awe-inspiring in terms of that welcoming and the hoop stance that was done to kick off the conference. So I hope that we're going to see many of you in Scottsdale next year as well in November. Believe me, you will want to be there for our next IFMA President's Conference. In terms of IFMA by the numbers, we brought in 46 new companies this year. If any of you are from one of our companies that joined us in 2022, welcome, thank you. We look forward to a long and fruitful partnership with you and your company in 23 and beyond. We had over 2,000 people register for our events. We had 212 people take the food service fundamentals class. We actually had more people take food service fundamentals in an online environment than we had take it in an in-person environment. And that is definitely the first time that has ever happened outside of course, a pandemic year. We had 38 webinars in 2022. So there's 12 months in a year, 38 webinars. Yes, we did over 3 webinars a month in 2022. And hey, we're going to keep going in 23. 6,570 of you registered for our webinars in 2022. So obviously we're doing something right, and we're going to continue to bring you high quality content through our webinar platform in 23 and beyond.